Today, in the world of crypto, who are you going to trust? Hello again, it's Martin North from Digital Finance Analysis, well-noticed posts covering finance and property news with a distinctively Australian flavour. And just before we start, a quick reminder that tomorrow evening, Tuesday at 8 p.m, I'll be discussing crypto and Bitcoin with Adam Stokes. And you can join us live and ask a question. So mark your diary and we'll see you then. As the collapse of Sam Bankman-Fried's FTX crypto exchange ricochets through the industry, this has not been a good week for Bitcoin and the crypto community more generally. Now we're going to begin to see arguments emerging suggesting that first, Bitcoin is not the same as crypto, and second, digital asset exchanges are rushing to reassure clients that their funds are safe. For example, Coinbase sends an email to customers explaining how Coinbase's business is different and ultimately better protects customer accounts and assets. Yet the biggest crypto exchange, Binance chief executive, warned last week of the potential for a cascading crisis in the crypto sector in the wake of FTX's failure, which he said could resemble the 2008 global financial crisis. It's worth noting that the total value of crypto, including Bitcoin, fell again. It's now at around $845 billion, compared with a peak of over $3 trillion not long ago. So crypto, therefore, is under the microscope as never before. As a conversation put it today in an article by John Hawkins, the senior lecturer, Canberra School of Politics, Economics and Society at the University of Canberra, he said not long ago FTX was one of the world's largest trading platforms for cryptocurrencies. Founded in 2019, the Bahamas-based crypto exchange had a meteoric rise to prominence and was valued at more than $30 billion earlier this year. All of that changed in the past 2 weeks. First, concerns emerged about links between FTX and an asset trading firm called Alameda Research, including suggestions that customers' funds had been transferred from FTX to Alameda. A few days later, rival firm Binance, that's the biggest crypto exchange of course, announced that it would sell its holdings of FTT tokens, a crypto that reportedly comprises much of Alameda's assets. Panicked customers rushed to withdraw funds from FTX, and the company is now on the brink of collapse with a banner message on its website announcing it is currently unable to process withdrawals. This is not the first such rapid disintegration that we've seen in the loosely regulated world of cryptocurrencies, and frankly, it's unlikely to be the last. The majority owner of both FTX and Alameda, Sam Bankman-Fried, had rescued other troubled crypto companies earlier this year. Now he's desperately looking for an investor with around $8 billion to save his companies. Many firms have already written off the value of their stakes at FTX, so it is not going to be easy for Bankman-Fried to find investors willing to put in new funding. Binance thought about taking over the troubled company outright. He decided against it, citing concerns about allegations of misconduct and an investigation by the US Securities and Exchange Commission. The price of FTT has now plunged. A week ago it was trading at around $24. Now it's less than $4. Trading in, quote, assets, unquote, with no underlying fundamental value on loosely regulated exchanges is always going to be very risky, of course. For many, it is likely to end in tears. Other kinds of assets are different. Company shares have a fundamental value based on the dividend, or at least an expected future dividend, paid from the company's profits. Real estate has a fundamental value that reflects the rent the investor earns or the owner-occupier saves, and the value of bonds depends on the amount of interest it pays. Even gold, at least, has some practical uses for jewellery, dental fillings, or I suppose electronics. But crypto, so-called currencies such as Bitcoin, Ether and Dogecoin, and thousands of other altcoins and meme coins have no such fundamental values. They are a game of pass the parcel in which speculators try to sell them to someone else before the price collapses. It is the ultimate, in my view, in multi-level marketing. Unregulated financial institutions are prone to the equivalent of a depression-style bank run. Once doubts emerge about their soundness, each person has an incentive to be early in the queue to withdraw their money before the money runs out. In a recent interview, Bankman-Fried gave a description of his business model that seems to rely heavily on funds injected by new investors rather than on future returns based on the intrinsic value of the assets themselves. These events have further eroded confidence in the crypto ecosystem. Prior to this latest fiasco, the value of cryptocurrencies had already dropped from a peak of more than $3 trillion US to $1 trillion, and it's now fallen even lower. Just as a few stars, such as Amazon, emerged from the wreckage of the dot-com bubble, so it's possible that only a handful of applications of the blockchain technology that underpins crypto have enduring utility. And the idea of an electronic form of currency is being realized in the form of central bank digital currencies. But as Hung Song Sing, the chief economist at the Bank of International Settlements, put it, everything that can be done with crypto can be done better with central bank money. Now, of course, the fact of the matter is that I have quick question marks about central bank digital currencies too, but that's for another day. The fallout, though, is significant across crypto and Bitcoin. Bitcoin is currently at around $16,416 US. Ether was at around 1,223 US, with balances of Ether, the second biggest cryptocurrency, dropping 7% in the past fortnight. That's a fall of around $2 billion US, which suggests some investors are pulling their coins from centralized venues in favor of storing them within their own systems. CoinMarketCap shows that Tether's US dollar stablecoin, the largest in the country, has faced approximately $3 billion in redemptions in the past 4 days. And Elliptic, a blockchain forensics firm, said on Saturday that there were indications that around 477 million in crypto assets had been taken from FTX late on Friday night. And Kraken, a crypto trading platform, froze a handful of accounts owned by FTX Group, its sister trading company, Alameda Research, and their executives on Sunday after talking to law enforcement officers. Those accounts have been frozen to protect their creditors, the company said on Twitter, adding that other Kraken clients were not affected. And Binance, meanwhile, paused deposits of FTT. That's a token issued by FTX to protect users. We've noticed a suspicious movement of a large amount of FTT by the token's contract deployers, the exchange said on Sunday, and offers suggestions as to how to keep their digital assets safe. So what you can see here is the continued crisis in the digital sector. And of course, the question is, how's this going to play out? Will Bitcoin reassert itself as effectively the foundational pillar of crypto into the future? Or will this mark a significant turning point and a significant rise in central bank digital currencies, which are now in the works? This, of course, becomes the critical discussion, which is what I'm going to talk about tomorrow evening with Adam Stokes. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.